Hello, and welcome to our third Carbon Smart Conversations webinar. I am Jennifer Owens. I lead marketing at Flow Carbon, and I'm very glad you're here. As our panelists gather, I'm going to share a little bit of housekeeping. First, all attendees are automatically muted, but you can ask questions. Please use the Q&A function at the bottom of your Zoom window. Dana will be facilitating our Q&A at the end of the overall conversation. A recording of the webinar will be shared this week on our YouTube and our socials. Please feel free to share and get it out there broadly. We appreciate it. And to that end, also follow Flow Carbon on YouTube and our socials so you get the updates on what's happening in terms of content and events. In fact, at the end of this conversation, Dana is going to give you a little heads up on what's coming next on our calendar. And to that end, I'd like to introduce Dana Gibber, our co-founder and CEO of Flow Carbon. Dana, the mic is yours.
Thank you. And to the viewers who are with us, thank you for joining for this Carbon Smart conversation. These webinars, the series of webinars that we've been doing, are designed to deep dive into topics that are impacting the carbon markets and its key players, as well as to continue conversations that surface at our annual Carbon Smart Summit, which is held during New York Climate Week and so is coming up. And we encourage all of you to join us in person there. But in the interstices of the great New York Climate Week conversations that we have at that summit and at other events, we have these webinars to continue the great discussions that we have as a group. So a little background on Flow Carbon. I co-founded our company in 2021 as a carbon finance and technology company that's committed to propelling the voluntary carbon market forward. Today, our team is focused heavily on carbon finance, with an emphasis on financing CDR companies and on carbon credit sales and project development. So I'm excited today to build on a conversation that was started in our last webinar, which took place in May. That one focused on supply of carbon removal credits, and in particular, biochar. If you didn't see that one, I encourage you to catch it on our YouTube channel. But today we're going to focus on the demand side of the market for carbon removal. And we have a lot to cover. It's a big topic, as we all know. So in that spirit, I'm going to briefly introduce each of our panelists and then dive into the great discussion. So to start with, we have Caitlin Smith, who's the manager of climate intelligence at RMI. There, she manages RMI's Carbon Markets Initiative, where she helps design, shape, and guide the implementation of her team's work to build trust, integrity, and credibility in the voluntary carbon market. I think we can all appreciate the incredibly integral role of RMI in this market and in so many climate-related markets, so we're thrilled to have Caitlin with us. We also have Seb Cross, who's the co-founder and chief innovation officer at B0 Carbon. Seb founded B0 with Tommy Ricketts in 2020, and today he's the Chief Innovation Officer, where he's focused on staying ahead of regulatory and market developments, as well as identifying opportunities to enhance B0's analytical and product offering as the carbon markets evolve. We are very, very glad to have his perspective on this panel. The ratings agencies have played an increasingly important role, almost transformative in the market, so we're very happy to have Seb with us. We also have my friend Jacob Bourgeois, who's the head of carbon strategies innovation at Volkswagen Climate Partner. So at VW, Jacob has helped establish Volkswagen as a really leading player in the voluntary carbon markets by establishing a leading joint venture offset portfolio strategy based on evolving market conditions, reputational risks, and shareholder interests. He has structured and leads Volkswagen's Carbon Market Intelligence Unit, focusing on developments in market price, jurisdictional, and Article 6 legislation, among other topics. Having the perspective of a real leader among the corporate buyer class is really fantastic for this discussion. So we're thrilled to have Jacob with us. And then lastly, we have Zach Penczak, who's the Director of Carbon Partnerships here at Flow Carbon. As his title notes, Zach is working to support a very robust portfolio of companies that are dedicated to offsetting their unavoidable carbon emissions. And he joined Flow Carbon last year from Aspiration and has brought deep experience and relationships working with Fortune 500 companies to serve their ESG and decarbonization goals. So we have a phenomenal panel. There's a lot to discuss. So I'll set the stage briefly and then hand it over to our panelists for a great discussion. In our previous webinar, the one in May, the one that if you didn't see, you should go watch on YouTube, we talked a lot about how biochar continues to lead the way in delivering durable carbon removal. The IBI and USBI global market report showed that biochar represents about 80–81% of CDR credit sales last year. According to CDR.fyi, close to 5 million tons of carbon removal credits were purchased last year. But it's important to note that a lot of those credits were purchased by Microsoft, which continues to reign as the lead purchaser of CDR in the market. It actually recently signed the largest biochar deal in history. I'm sure many people caught that news. And so as we learned last time, suppliers are scaling to meet demand. And today we're focusing on how buyers are responding to that increased supply. So Caitlin, I'd love to start with you. RMI and the Climate Collective very recently released a buyer's guide to carbon credit data quality, which notes the positive impact that these early major CDR buyers like Microsoft are having on the VCM, while also noting the criticism that some buyers have faced regarding their credits. Now, a lot of people in a really sort of knee-jerk way like to categorize quality in the market and the line between good and bad quality as nature-based versus CDR. Nature-based are, of suspect quality, really hard to determine quality, and engineered CDR credits are, you should feel better about that. But in reality, that's not the case, is it? Can you give us a sense of how buyers actually are judging projects and how this is impacting the market?
Yeah, Dana, thanks for that question. It's a very, very important one, I think, to kick off this discussion. I think part of what is relevant or kind of has shaped that conversation is just the evolution of the carbon market. So increasingly right now, like we did for our buyer's guide, we did a lot of interviews, kind of talking to both a lot of buyers, a lot of brokers, kind of people across the landscape. And we kind of drilled into a few consistencies and themes that shape how all buyers are thinking about quality. And I think it's important to start there because that feeds into the kind of knee-jerk reaction that you mentioned at the top. So across the board, all buyers are kind of looking for credits to fill strategic climate goals, right? And so we all know these, but this is generally buyers kind of have looked at what they can do through direct decarbonization, and they've settled on carbon credits as a way to complement those efforts. And that means that they have increasingly buyers have specific reasons for what they want the credits to do. And this is a shift from kind of in the pre-Guardian era, where I think buyers were a little bit more they weren't as thoughtful, I guess would be the way to say it, in terms of thinking about what they were buying and why they were buying carbon credits. So that's, I think, the first shift. Generally, we find that buyers the whole market's in agreement on what a quality credit means. And so that, we know that means credits that are durable and additional, that have good baselines, that have minimal leakage, and that have high socioeconomic and biodiversity equity benefits. So this is kind of broadly that's what buyers want, right? But with carbon credits, the devil is always in the detail. And so kind of the nature-based for CDR debate really fell into how do credits prove that they're additional? How do they prove that they're durable? How do they prove that they have good baselines? Kind of how do they prove that they're upholding the quality principles? And the kind of theory is that, or the reaction was that a lot of kind of avoidance nature-based credits have a harder time hitting those principles than CDR. And in reality, what we learned through our research is that it's not that clear cut, right? There are kind of avoidance projects that are able to hit the quality criteria. And the way you discern that is in the data that they're providing and the MRV processes that they've built out, and in kind of how they're overall managing the credits or the projects once they're implemented. And then on the CDR side, there's so many different types of CDR projects, and they're all at different stages of kind of advancement or sophistication. And so there are some CDR approaches that are really ironclad and do a very good job having the data to hit the quality criteria. And then there are others that are just beginning to experiment with scientific approaches. And those ones, again, it's all about what is the data that the credits are delivering and how does that help buyers feel confident that what they're buying is going to deliver what they want. And at the end of the day, it's the same reason any of us look for products, right? We want to buy things that we are confident are going to perform the way we want them to. And it's the same kind of shift that's happening on the demand side for carbon credits.
Yeah, that's very helpful. The guide, of course, offers a really great actionable framework for buyers to assess the quality of the credits that they're buying, so that buyers who, might not have an extensive team that can vet every project, and maybe deep expertise in the market, they actually know what they should be looking for, how to start making these kinds of quality related assessments. An interesting question that comes up a lot is, what's the correlation between quality and price in the market? We see a lot of buyers trying to use price as a proxy for quality. Like, I'll just go with the really expensive credits and hope for the best. But are you seeing that? And do you think it's a reasonable approach?
We do hear that a lot. And I think it comes, I think, from a lot of different places, I'll say. And so part of that, especially for CDR credits, is that buyers are buying for different reasons. And so in a lot of cases, the CDR credits have been purchased to prove a technology or to scale an approach. And so the price, there are some very high prices, and in part, it's to signal demand for something that eventually needs to come online. That is, and part of that, it goes back to kind of the initial reasons that people are buying credits. We are seeing as well that a lot of project developers are incorporating kind of more sophisticated approaches into their credits, or they're partnering with the rating agencies and they're kind of like expanding their pitch into why they have quality credits. And then those kind of are coming with a higher price on the market. But we don't see it as clear cut as high price automatically means a high quality credit, because the ability for the market to discern and agree on what is high quality and what are buyers willing to pay for, is still evolving, I guess I would say. And so it's moving, but it's not quite sorted as that clear cut.
Yeah, I'd agree with that. I think any project developer, nature-based removals, so nature-based avoidance, nature-based removals, or engineering removals, I think it's kind of safe to assume that any project developer that knows that they have an extremely high quality project, they are going to price that into their credit price. But it is not the case that is sufficient to know that the underlying project is of a high quality, because you have lots of projects that aren't quite there that are also trying to price accordingly. So it's really interesting, but it definitely gets to the importance that ratings are playing and can play in this market. So Seb, I'd love to shift to you and talk about ratings and the role they play. So last September, B0 published an industry first CDR rating for a biochar project. This was, I think, the first for any ex-post CDR project. Can you share why this is important for not only biochar, but for the CDR market as a whole, how it came about, what the reception was? That'd be great.
Absolutely. Thanks, Dana, and thanks, Caitlin. I think you've done a lot of work for me in teeing this up. As you said, what quality looks like in the market, there's a general consensus on, and yet the use of high quality as a label, particularly in the CDR space, you see it used quite often and indeed quite arbitrarily. And people are increasingly starting to ask, high quality according to who? It can't just be the case that projects promoting this themselves can necessarily be trusted, or indeed can be relied upon by buyers or investors. So the role of ratings in this space is really, really clear from that perspective. It was easier in the early days when, particularly in the CDR space, there were very few projects, and it really was, novel technologies being tried for the first time, and they were right at the top of the cost curve and the frontier of innovation. But fast forward to today, and we've seen, particularly in subsectors like biochar, there's a huge number of projects that are now coming to market, and there's a big variation in these projects and the techniques that they're applying, the technology they're using, calculations that they're applying to the credits that they're issuing. Both buyers and investors have to be increasingly more nuanced about how they think about this, and they need tools to be able to do that. Yes, you have the Microsofts of this world who have big in-house teams to be able to do that. Although even players like Microsoft are utilizing other tools, but for smaller players to kind of crowd them into the market, they need to be able to rely on an independent third-party assessment to be able to make informed decisions, and that's the role that we've been very excited to play in other parts of the market to date, and we're now very excited to play in this part of the market. We had great reception to the first biochar rating. We've launched another since. We've also launched the first BECS rating as well. It's not just telling you about the quality at the project level, but it's also, I guess, the process that projects are going through in order to get rated, to that point around people wanting to do their own due diligence on top of any tools that they're using. It's interesting. We found in the early days of trying to rate the space that projects, particularly in the CDR space, just didn't have that much data and information available. They didn't look like projects in other parts of the market in terms of how their carbon accounting was presented, in terms of the assumptions that they were applying, additionality tests, etc. So we've actually had to do a lot of work in getting a lot of these projects to a point where they pass our tests to be eligible for a rating. But we don't just do that on a kind of bilateral basis. We encourage them to publish that information so that we can not only use that to rate a project, but anyone can therefore see what the projects are doing, and that transparency can help build trust. So the market has come a long way from that perspective, and it's exciting to see that. As Kate was saying, that price is not necessarily entirely indicative of quality in this market. There's still kind of a lot of proxy factors being used in how people perceive and attribute value. But we've gone from a world where we saw very little correlation between our rating and pricing in the market to starting to see some correlation emerge. So people are starting to use these tools to attribute value, and I think that's also reflecting of the way that people are going about these buying decisions. Is not just purchasing based on, like, say, proxy factors, for kind of internal drivers. It's more being perceived as a risk management exercise in building a credible and robust net zero strategy that is going to stand the test of external scrutiny, and the rating is central to that. So very excited to see the traction that it's getting in the market, and very excited to be publishing more ratings in this space, and to be crowding in more buyers and investors.
Yeah, absolutely. You and I have had a couple of really good conversations beyond just looking at how you rate a project. Obviously, you're very intimately familiar with the project side. You guys get, as deep as possible with projects and understanding the fundamentals of the projects, their challenges, everything about them, basically. But you've also been very thoughtful, you in particular, around some of the other things that are needed to scale the engineered carbon removal sector, right? Just industry-wide, what are some of the key ingredients that will lead to scale for engineered removal projects? So I'd love if you could talk a little bit about, zooming out, what you see as some of the key things that'll scale both the supply and the demand side of the market.
Yeah, absolutely. So look, as an ex-fixed income analyst, I obviously have a natural preference for debt products, and I'm acutely aware of the lack of debt in being utilized in this space, given the investment requirements that the CDR has. If you look at some of the numbers that it's estimated to need to get us to where we need to be in 2050 to meet some of the IPCC targets, it's equivalent to building the Chinese economy today. Is just astounding. In the next 5+ years, we need to create the equivalent of the economic output of China in a year. That's not going to happen through expensive VC funding. That needs to happen through debt funding. But that type of funding comes with additional questions and a very different return profile, and indeed much more stringent risk management criteria. And so that question of making CDR projects bankable, carbon still does not look similar to what these traditional investors are used to seeing in other asset classes. And so we've been doing a lot of work to see how the rating can help unlock debt financing in this space. When we look at a project prior to it issuing credits, part of our assessment includes a project execution risk component. So what is the likelihood that the project will actually get off the ground and become operational and deliver the credits that it intends to? And this is really, really important, for being able to track this sort of financing, obviously on top of the offtake agreements and the alternative revenue sources that you see in different areas. But I think the CDR space is, there's obviously a much broader debate going on in carbon credits in general as the role that they're going to play in net zero strategies. We'll see where SBTi lands tomorrow, but in your kind of big Venn diagram of all the different parts of the market and where they're likely to fall, the CDR space is often put right at the top as most likely to be included in most outcomes here, because, like I say, we know that we need to scale our removal capacity if we're going to stand any chance of meeting the top down targets that we're aiming for. But we're still at the top of a cost curve that we need to rapidly get down if this is going to look anything, if we're likely to even be able to reach those targets. And so being able to attract debt financing, but also being able to attract solid demand pools, that's not just going to come from the voluntary space. That needs help from compliance market, that needs big compliance schemes like in Europe and elsewhere, charting a clear course of the inclusion of CDR against these liabilities, so that investors can build that confidence and that we can see investment today for the time it takes to actually scale it up and get to where it needs to go in the future.
Yeah, I couldn't agree more with that assessment. At Flow Carbon, we are very focused, as you know, on securing project finance for those CDR companies that are bankable and can actually access that pool of capital. But I couldn't agree more with your overall assessment. I will say that a lot of the heavy lifting has to come from the buyer side of the market. So I'm thrilled to shift focus to Jacob to put our conversation in a very real context as a buyer. So Jacob, as a buyer who has a lot of experience building out a carbon offset portfolio for one of the most important international companies in the world, how are you viewing the CDR market today? What's exciting? What's challenging? What's top of mind for you?
So first, Dana, thanks a lot for inviting me to give our perspective, even though it's quite late in Munich. So this will be the end of my day when we finish up here. And really great points, I think, from the other panelists. I'll just give the kind of the humble buyer's perspective on this. So in terms of my experience, I'm probably a bit too young to be making this comparison, but I think we're viewing the CDR market today is very similar to the initial surge of energy that we were seeing with the emergence of the Kyoto Protocol and CDM when those were first emerging, but on the removal side. So all these questions were raised around, what intervention types are out there, what can be scaled, where can carbon credits make a difference, as opposed to other forms of finance. What should the standards look like? What should they be doing? What do we know about the downstream effects? What do we not know? And what are the implications from a risk mitigation perspective when it comes to integrity, permanence, additionality, and so on. So we know that the CDM largely spawned the offset markets as we know them today, with a huge focus on kind of avoided emissions credits or reduction credits. And there was always this recognition that policymakers and market participants kind of punted on the topics of CDR, just leaving it for future generations to handle. So I think it's really exciting now to see, this excitement again, all this innovation, all these open questions, debates that I think will really set the stage for where the market goes over the next decades. As we kind of try to hit these targets that Sebastian was mentioning before. So maybe a little bit more concrete in terms of what we're observing as buyers, and then especially for me, kind of coming more from the public policy due diligence, market intel perspective at VCP. Of course, we have the emergence of many new standards in the last years. You have per-earth, you have isometric, you have many others that are really focused on CDR. And then you also have the established standards trying to kind of step up, moving into the CDR space, even though they're proceeding kind of at a slower pace, I would say. And it's interesting, of course, to see the different approaches, what they take into account from a methodological standpoint, safeguards, all of this stuff. So that's all very interesting to watch. I mean, I think you also have this very interesting new development in the offset insurance market, which, it applies to the offsetting world generally, but it's particularly addressing many of the key risks associated with CDR related to permanence and financial risk. So, thinking about higher unit costs, higher investment costs, things like this, that for buyers are very, very important to think about. Also, crucially, I think you have actors at the policy level trying to set standards and deal with the thorny technical issues that could really scale the removals market. So, you're seeing this play out at the international level under the Article 6.4 supervisory body at the UN, which is really, I think, centrally putting removals at core to their discussions. That's really been one of the hiccups, I think, in the last years for the negotiations. And then also kind of more regionally focused, the EU's CRCF, for example. They developed this framework, and that's something we're watching very closely because I think you can set the standard for what a lot of developers, how they'll be orienting their approaches towards for buyers in the market who are really asking for this. And then you're really seeing some interesting experimentations happening in specific country contexts with blended finance approaches. So, combining public subsidies with private finance to try to bring the cost to the private sector down. That's very important, especially for us thinking about the cost perspective. And I think for me, this is really important when I think of the challenges in CDR, where it can still feel a little bit like the Wild West sometimes, kind of the early days of the Kyoto Protocol. So, I mean, we all saw what happened after the CDM wound down, and the technical and political questions were largely left to the VCM standards themselves to figure out. And we've all been dealing with the blowback from not having a consensus on fundamental questions related to integrity, rigor, use case, and so on from very early on. So I think we're still all dealing with that. And I think for us, kind of relying on these political discussions for market clarity, it has been frustrating to watch, as for all buyers, because it's proceeding at a very slow pace. It feels too consensual almost. But I think getting the institutional technical frameworks right at the beginning is super important. I mean, it's critical, and it'll be very important to help us avoid a repeat of what happened in the avoidance market credits in the last years, essentially, kind of what we've all been dealing with the slowdowns in demand. So I think for us, it's really important to quietly observe how all of this is playing out as we make our investment decisions.
Yeah, that makes a lot of sense and mirrors what we've heard from a lot of buyers. As you kind of sit and quietly observe and also are informed by the sort of learnings over the last, call it 18 months, even 24 months on the nature-based side of the market, what do you think, or what's emerging vis-a-vis your approach to due diligence and risk assessment when it comes to CDR credits as opposed to your nature ones?
Okay, no, that's a really good question. I mean, I think maybe I'll start with how CDR fits into our portfolio. So I think like a lot of buyers, especially the larger ones, we take a mixed approach, which is pretty typical. So most of our volume is coming from a fairly even mixture of nature-based solutions projects, both removals and avoidance, and then technical projects supporting the energy transition, green infrastructure, methane abatement, interventions like this. And there was always this idea that we take a project development approach. That was really why we were set up, which means that for most of our portfolio, it should consist of engaging with early stage projects that need support in one form or another, whether it be financial, technical know-how, or just whatever it is that they need from us. And I think CDR in principle fits very well into that overall concept. But so far the engagement has been rather limited and opportunistic, just because it's still a very nascent market. I think where we're starting to see more traction in integrating CDR projects into our own portfolio is when we start to work a little more closely with specific brands, especially those who have made a commitment to secure a certain percentage of credits coming from CDR. And that gives us more of a free mandate to integrate these where we see good opportunities. And we're starting to see this happen more and more. So it's picking up. I mean, we're still not a Microsoft. We're kind of not really in this group, I would say. The volume is rather limited, but it's starting to solidify, and we're starting to see some kind of strategic decisions made internally around these. And I think another helpful development's been the beyond value chain mitigation approach, which really helps us kind of engage with emerging technologies as they are, and a bit more easily than taking a ton for ton approach, because we still have to see where this goes, as Sebastian was mentioning, from a decarbonization perspective and what tools you can actually use. So to get to the question about due diligence and risk, here again we have the same challenges that many of the interventions we're looking at in CDR are rather new. So this was already discussed by other panelists. And there's fewer off-the-shelf resources available compared to more established intervention types. Of course, these are growing. These have been mentioned just a few moments ago, I think, but still, it's taking a sector by sector approach so far. Is at least the kind of feeling that we have. But that being said, we've always developed a risk-weighted due diligence approach per project type that takes into account our own internal know-how as well as external resources that we hire out for. And in this case, we can simply carry over, I think, many of our existing processes. So that's not particularly new. We would just pay special attention to carbon accounting, permanence, other areas where CDR credits could potentially be problematic. And then, of course, for that, we would potentially hire external technical help for this to help us set up a more robust framework. So, I mean, we're not alone there. We don't do everything internally, but we do try to develop our own approach and opinion, just depending on our own experience as well as kind of what our clients internally at VW are looking for. And of course, the rigor might change a little bit as well for due diligence, depending on the claim we're trying to make with the engagement.
Yes, undoubtedly. And it's interesting to see this happening as the CDR, the engineered CDR space is evolving itself, right? You mentioned that there's a number of new standards that have sprung up. There's a number of new methodologies. There's announcements, it seems like every other week, around new standards and new methodologies. And so, whereas, yes, you can definitely leverage your historical due diligence processes and frameworks in some ways, in other ways, this is very new, uncharted territory. And so marrying that is, I'm sure, part of the fun of your job. With that, I'll turn to Zach and bring Zach into the conversation. Zach, you're constantly speaking to buyers, both big and mid-sized, and you see demand for everything. Oftentimes it's purely a nature-based portfolio. Other times it's a mix of multiple kinds, including nature-based and engineered removals. What sorts of challenges and opportunities are you hearing on a recurring basis from buying partners when it comes to CDR specifically?
Yeah. Thank you, Dana. And thanks to all the rest of my panelists for providing a lot of great context from their perspectives. I think one thing in a couple of things in the area of challenges that we are all seeing right now, and this has been kind of touched upon and alluded to a few times, but there still is an opaqueness around quality that causes a lot of hesitancy or a lot of kind of reluctances to commit from the buyer perspective, and especially buyers that might not have a team as built out and as established as Volkswagen Climate Partners or Microsoft or other firms that we've mentioned today. So the questions around quality, I think, is a big challenge. And then I think kind of digging a little deeper there, certain companies, I think a lot of the players in the market are still kind of trying to figure out which questions to ask and which questions to prioritize as it pertains to quality and as it pertains to kind of setting their preferences and their guidelines as it pertains to their buying criteria, which is, why an agency like B0 and the work that Seb and his team are doing is so vitally important in really helping companies and buyers and suppliers really understand, the main touch points and the main pain points that do exist when it pertains to quality of credits and of projects on a more holistic sense. And then on the opportunity side, I think with CDR right now, one thing that 2024 has showed us is kind of a flight towards removals credits, or a really increased interest in concerted demand for those types of credits. So I think that when my team is talking to projects in the removal space, there is an increased excitement and kind of faith that they are having that the demand will continue steadily and continue to grow for those types of credits. And then consequently, I think that what we're also seeing, which is a really good characteristic of the market right now, is an increased prioritization from buyers on market-wide quality expectations. So I know, I kind of just touched on there might still be that uncertainty around, what is the exact criteria when it comes to quality, but the understanding that there needs to be deeper and more thorough and robust due diligence done on projects prior to purchasing is overall that kind of rising tide that raises all boats as it pertains to the market at this point in time. And then the last thing I'll list there on the opportunity side is really the way in which value chain alignment is becoming an increasingly important priority for buyers. So understanding how the projects that these buyers and these companies are investing in or buying credits from can pertain to the work being done inside the value chain of these companies. And I think that, again, this is a really good signal for the market that we are seeing a lot more educated buyers, and we're seeing a lot more companies who are understanding kind of how credits can play in their broader decarbonization journey. And then finally there, to kind of bring it on back to Flow Carbon ourselves, I think this is really an area that we are pretty razor focused on at the moment, is going out there and speaking to a lot of different projects and project developers globally in a number of different project types, whether it be nature-based removals, whether it be engineered removals, and even still, project developers in the nature-based avoidance space, and understanding how we can be constructing our relationships and our portfolios that will best fit the demands of the buyer side of the market. It's exciting to be able to kind of press play on a lot of conversations that might have previously sat a little bit deeper on the sidelines just because of where demand signals were coming from in the market, and understanding how we can continue to iterate on creating this multifaceted and holistic portfolio and long list of relationships and partnerships that we're creating throughout the entire voluntary carbon market.
So to the extent you have seen some of this demand for CDR credits, engineered CDR credits specifically, manifesting, can you break down the different ways that buyers are engaging? Meaning, is it spot? Is it forward? Is it through offtake agreements, multi-year offtake agreements? How has it to date really been manifesting? And what do you see as the sort of medium and longer term evolution in how buyers are accessing credits?
Yeah, definitely. So I would say in terms of the volume of transactions that we are seeing in the market, the spot market for credits is still where most companies are looking to play. So I guess it might be helpful to give a quick refresher there. So the spot market being credits that are ex post credits that can be delivered and retired immediately by buyers. Forward contracts that you mentioned just now, Dana, that would be when a company or an end buyer is committing to a contract for a credit that will be issued in the future. So ex ante credits there. And this would be set at a set price and a set volume for delivery at a future date. And then finally, the multi-year offtakes that you mentioned as well, that is where companies are committing to multi-year agreements in which they would be procuring a set volume or a set percentage of credits produced by a project on an annual or at times quarterly, but typically annual or biannual basis for the tenure of the contract. In terms of where we are seeing most of the demand come from, again, it is still in that spot market area. So ex post credits are the most heavily demanded by our clients and by companies that we are speaking to. I would say that it's an interesting kind of time to look at those three buckets right now, because we are seeing more companies that are interested in having conversations on the offtake side, but forward contracts are still kind of a difficult area for a lot of firms to kind of consider playing in at the moment. And in terms of rationale for that, and in terms of kind of general rationale for those descriptions of the market that I just mentioned, and Seb kind of alluded to this earlier, we're still waiting on seeing a lot of international and domestic guidelines coming down, with hopeful news from SBTi in the next 24 to 48 hours as to updates on their policies. And I think that as those updates come through and kind of the dust continues to settle throughout the rest of 2024, and especially going into COP in November, we will likely and hopefully see continued shifts in the market to more companies looking at forward contracts, more companies looking at offtakes as a viable way to meet their net zero goals, or both their short-term and their medium and longer term goals as well.
Well, that's first of all, that was a great primer on the different ways that buyers are actually accessing carbon removal credits, offtakes, forwards, spot. I think we've gotten through a lot of this webinar without mentioning the sort of F word in the space, which is Frontier, right? You have buying groups like Frontier, which have committed to purchasing, I think Frontier, it's $1 billion in permanent carbon removal by 2030. They've spurred a lot of the sort of energy and actual purchasing around carbon removal. And so a question before we go to Q&A, a question for everybody on the panel is, what impact has the Frontier buying group had in galvanizing other similar purchasing? Like Jacob, we could start with you as an actual buyer in the market. Was it in fact the case that a group like Frontier can come in, can kind of lead the charge, get some early purchases going, sign some offtakes, and then it kind of sets the stage and the tone for other purchasing? Or are there other things that have to happen, you think, before buyers will step in a maybe a similar fashion?
Yeah, no, that's a really good question. I mean, I would say internally, at least for us, it's been difficult to say what the effect is. I think of course, I've been watching what they're doing with great interest, and I think it does provide an impetus to try to push this a little bit more internally, and I've done my best to do so. I think where I do see some influence happening is particularly with certain brands within the Volkswagen group. So some of them will see it, especially the more kind of technically minded. In the end, it's a car company. They're engineers. This is kind of almost a natural fit for them, more than kind of the traditional voluntary carbon market intervention types, where I mean they're almost having to kind of wrap their heads around things that they've never thought about before. So I mean, I think for some of them, they'll read these articles, they'll see these developments in the CDR space in the US in particular, and say, hey, can we look into that as well? Where is it possible? Where is it available? Can we do it in Germany, for example? And you will get more questions coming in. I don't know if it speeds up the process, but I mean, it definitely has an impact, at least from an interest perspective, I think.
Caitlin, any thoughts on the role that Frontier has played in sort of galvanizing a more robust buying environment?
Yeah, it's a great question. I mean, I think we wouldn't be having this conversation without Frontier. And there are a lot of CDR suppliers and a lot of kind of ecosystem service providers that have kind of been able to step into the market and to gain traction because of Frontier. And so in that kind of from that perspective, I think they've done a critical job, which is signaling there's a demand for this market and signaling that there is appetite and space for kind of these technologies and these processes to get figured out, right? And that in the absence of kind of other demand signals, like that is how you build a market, is you need a demand signal. I also think that they're kind of, if we can't just rely on the model of really deep pocketed buyers coming in to build this by themselves, because like we've talked to a lot of buyers who are kind of for various reasons on the sideline, or just don't have the risk appetite, don't have the resourcing to do what Frontier has done, and to, or even to build out their own kind of model or coalition. And so kind of I see it as like they've kind of cracked the dam and they've started the flood, and then you need other systems to come into place to kind of help people who see where they're going and see the value, but don't have the same resources to get to the same point. And so that means, yeah, like clear guidance from it. Like, it'll be really interesting to see where we are on Thursday once we know what SBTI has said, because that has been a huge thing we've heard from a lot of people is they're not going to buy, people who are more risk avoidant aren't going to buy credits if there's some ambiguity about how they can be used. And so that'll be interesting. I think that, the policy space has kind of been talked around, but to the degree, I don't think anybody here wants to rely on the voluntary market to solve all of our problems. And so having government policy come in and kind of help shape the market and help provide some of the backstop to the quality issues we've talked about, or the data issues, or the pricing, those kind of mechanisms will help, I think, the next tranche of buyers really build off the momentum that Frontier has started.
Yeah, undoubtedly. And it's interesting what you said about how in the absence of a clear framework by SBTI for use of carbon credits, many companies won't engage. I think that's very true. On the other hand, we heard Jacob's perspective where the sort of BVCM framework did give you, Jacob, it seems, the space to actually go and start exploring some CDR technologies. I'm sure it could be limited. It could have been sort of initial, but not sufficient to scale CDR purchasing in the long run. But we see how the sort of, I mean, we all know the role that SBTI plays in galvanizing this. I think we're all waiting with bated breath for Thursday. I guess for some companies, BVCM, which is, for those of you watching, Beyond Value Chain Mitigation, gives some opportunity to explore CDR technologies, but it's I think many people would agree it's not sufficient to actually create a viable and sustainable market. Seb, I'll go to you quickly on this topic of Frontier, or anything else you want to say before we go.
Thank you. No, I think you can't understate the impact that it's had on this market in really galvanizing. You see businesses starting up in this space just to try and sell to or indeed get investment from Frontier. And so in terms of being the catalyst for the early stages of the market, it's been huge. But to Caitlin's point, you cannot build a market off of this, right? And this is really, really important from an infrastructure perspective. What Frontier is doing is not sufficient infrastructure to build a market. And that relates to reporting. It relates to assessing credits on an ongoing basis. It relates to credits as a legal contract, like what a carbon credit actually means in terms of its commitment. To build a market, you need to have consistent, standardized reporting that tells you everything you need to know about carbon projects, in the same way that public reports tell you about a company, particularly once it's listed on an equity market. We don't really have that in this space. We're still waiting to see this come in a digitized format in this market, which is really mad considering how quickly you're trying to scale it. And so, groups like Frontier can't be the ones driving that. Likewise, on additionality is increasingly going to matter for this space. It's been taken as an assumption to date because there's been such a lack of funding for these new technologies. But as they do scale, and particularly as governments get involved, what is the marginal impact of selling a carbon credit on the likelihood that this project is going ahead? We've already seen this for some of the early stage vector projects, where additionality is, you can't just assume that these carbon credits are additional. You have to be more nuanced, and that relates to the reporting of the underlying dynamics and assumptions. And finally on stuff like commitment periods, you often see in this space, it's durable for 1,000 years, right? But nobody's selling you on a 1,000-year contract. So just the assumption it's going to last for 1,000 years is not sufficient for an investor to come in and for it to pass due diligence, you have to have a legal contract in place that has all of the right kind of dynamics, so that if a project does fail or there is a reversal, that there's legal recourse in place, and that it has the legal backing that is required in other asset classes and their markets. So some of these key factors we're still missing in this market, and like I say, groups like Frontier can't be the ones to drive that. This has to come through policy. It has to come through groups like SBTI, the registries, and creditors that we see growing in this space, but also exchanges and other means of trading credit and getting liquidity, and transparency on pricing. There's loads of components that we see working in other markets and enabling them to actually function that we need to bring into this market for it to scale.
Yeah, I think it's hard to disagree with anything that you said, basically. Zach, any final thoughts about Frontier or anything else before we move over to some of the targeted Q&A that's come in?
Yeah, happy to make it relatively quick so we do have time for Q&A. I think that really following up on what was said by the rest of the group here, it is kind of one of those situations where we as a market are hoping that Frontier walks so the rest of the demand for engineered CDR can run proverbially. And I think that those market signals and the ability for a group, an organization like Frontier and the companies that make up Frontier to catalyze a lot of the technological and financial development and really kind of the understanding of how we can be seeing these contracts that Seb just detailed created and making these bankable for institutions who want to come in and finance these CDR projects. That is such a vital role that Frontier and other buying coalitions are playing in the market right now. But ultimately, for scalability and for longer term sustainability of the market, as at a broader sense, we are going to need to see a lot more individual actors who will and can play in the space, both from a financial and a technological readiness perspective with their buying preferences. So whether it be news that comes down the pipeline for all of us in the next few days, or more agreements, more commitments being made by other companies throughout the voluntary carbon market, I think all these pieces are necessary for us to be really actively and effectively attacking the goals that we all collectively have.
Excellent. We've had a bunch of really good questions come in, so we're going to try to get through them sort of rapidly because they're just a bunch of very interesting questions. I'll start with a very targeted and specific one, which is directed at you, Jacob. Does Volkswagen look at permanence of biochar CDR credits? Does it matter to you as a buyer if they are 100-year or 1,000-year permanence?
Short answer is it doesn't matter so much to us just as a one single factor. I think the other factors that were just raised, thinking about durability, the permanence, the contracting behind it, the infrastructure, the context of how the project is developed, what safeguards are present, what the project's actually doing. I mean, usually there's a big distinction between the intervention types and biochar when you're looking at kind of the long durability versus short durability ones. Is it a project we would like to support? Where is it located? I mean, there's just a whole kind of, I guess, ecosystem of issues around that we wouldn't necessarily just look at, okay, longer durability, therefore it's a better project. It would be much more complicated than that. So short answer is consider it, but it's not that critical.
Got it. And so a 100-year permanence is not a disqualifying. Got it. Caitlin, in light of your research, what are some of the initial reasons that buyers have for purchasing CDR credits? Like why, what about it compels them in the first instance?
Yeah, I think there are a few different reasons. One comes to the role that the buyers think that they're playing in the market, right? So the Frontier buyers are a great example of this. The clear motivation there was to scale a market. They saw themselves as being leaders. They saw themselves as or the motivation was to signal demand for something that is absolutely critical. So it's a climate priority that they're acting on, and there's kind of a financing I don't want to say altruistic, but a vision of catalyzing technologies and markets from kind of as an investor angle. There are people who are buying. We call them kind of like the recalibrated, buyers who were buying avoidance credits, who have been for various reasons, recalibrated internally about what their priorities are and have shifted to buying removal credits. Maybe they're buying fewer credits at a lower price point, but they have confidence, or they've kind of seen it as that removal credits are better suited for their risk profile. And then there are some where they're buying not necessarily for insetting purposes, but buying biochar is a great example where a lot of consumer goods companies will buy biochar because of their footprint. And so they're synergetic. The removal operations are complementary to where their operations are, or where their socio-environmental goals are, and that's where their priorities are. But those are kind of the big three buckets.
That's a nice way to lay it out. Zach, does that align with the buyer sentiment that you see as the sort of impetus for them even considering CDR in the first place? This relates to a question that was directed at you, which says, we hear about buyers waiting and seeing and sitting on the sidelines as a mentality right now. The question is it equal across the VCM, or do you see some movement in CDR? But I think that relates nicely to tying it back to what Caitlin just offered around, for those who are not sitting on the sidelines and who are not waiting and seeing, but are actually starting to take initial steps to purchase engineered CDR, are those the sort of galvanizing sentiments that are leading them to do so?
Yeah, I would say so. I think that when we look at, you know, the rationales of why certain players or kind of lack thereof players in the market in the engineered CDR space are acting the way that they are versus companies that are players in the engineered CDR space, I think, you know, you can't avoid talking about what budget has been outlaid for the purchasing of credits and the longer term investment strategy that a lot of companies who are active participants in the engineered CDR space have for their company, both from a sustainability perspective as well as a financial or technological perspective. I think that there also is general kind of hesitancy that more broadly buyers are showing with engineered CDR purely around the price point that we're seeing on a per ton basis for credits. I saw somebody ask in the chat, you know, why are companies buying $200 CD or biochar credits when they could be buying $1 or $2 like NBS avoidance credits? And what that ultimately comes down to, and what Caitlin really nicely touched on there, is how companies are looking at biochar and other engineered CDR project types to play a part in their value chain and play a part in the work that they are doing as a company. And that's where we are still seeing a lot of demand, a lot of interest, are companies who understand how biochar can relate to the work that they're doing, and kind of whether it be the commercialization of the physical biochar in some aspects, or more so the story that can be told by purchasing their credits. The demand does exist in those pockets of the market.
Really interesting. Seb, there's a question directed at you, which actually relates to something I didn't get to ask you yet. And so the question for you is, there's a level of uncertainty about carbon crediting data. How are ratings evolving to increase transparency and trust? How this relates to what I wanted to ask you is as follows. We've already touched on the fact that engineered carbon removal sees ever-changing industry guidelines. A lot of it is new and emerging guidelines, methodologies, even standards bodies that are coming in and creating methodologies in the first instance. So how can ratings how can ratings keep up with this evolution of this new sort of and nascent pocket of the market?
Yeah, I mean, I guess I'd kind of, you know, if you strip back to what the rating is actually doing, we're assessing project activity on the ground that is designed as an intervention to either, you know, reduce or remove carbon. The methodology that a project follows and the subsequent credits that it issues is just, you know, a reflection of that, or should be a reflection of that activity. But you know, and this is reflecting the work that we're doing. You know, the voluntary carbon market is just one way to reflect that. You see it reflected in compliance markets through stuff like the APU market, or you know, others are emerging elsewhere. You know, we've designed our framework so that we're really just trying to assess that project level activity and the extent to which the broader context matters. And so from that perspective, a lot of this is like a statistical exercise, right? How much data do you have, and what are you trying to use ability to gather data on a whole host of different factors, particularly with Earth observation on the nature-based side, but likewise, tech removal side, where you have kind of life cycle assessments of embodied carbon leading up to the removal of carbon. It's that data question is relevant throughout those conversations. Ratings are a reflection of that. They are a reflection of the fact that as data improves, we can have greater confidence in that estimate, and therefore greater confidence that the credit that is a reflection of activity is achieving what it kind of says on the tin. And so it's I guess quite exciting for us as a business, because we see ourselves at the forefront of this across multiple different sectors. We have a fantastic geospatial team. We have a fantastic carbon tech removals team. We're constantly trying to dig into these latest technologies and approaches to try and really strip it back and see to what extent it answers that core question of what is the likelihood that this credit is actually achieving the ton of carbon that it says. Ratings from that perspective, we're you're starting to see the conversation evolve into the methodology is just, like you say, a reflection of it's kind of like a recipe, right? You can, there's multiple ways that you can follow a recipe, and it leads to multiple different outcomes. That is as relevant to the VCM as it is to regulated markets. Regulators have typically had to just rely on methodologies to think about what's eligible for certain schemes. But we're having some really interesting conversations with governments, and to the extent that, as I say, ratings can be a reflection of the underlying data at a project level, and therefore can enable governments to have more nuance in how they're thinking about eligibility for various different, whether it's carbon taxes, ETS, etc. So yes, to a long-winded answer to your simple question, we can help in understanding that uncertainty, and indeed try and drive higher standards in people utilizing the technology and data that's available today to be constantly reducing it and improving it.
So we are just about at time. I want to wrap up by offering Jacob a final question. So Jacob, you've always been one of the more thoughtful observers of this market. And as always, the VCM is in transition. You hearkened it back to the days of the Kyoto Protocol earlier. If you could just leave us with a thought about where you see the moment, what kind of moment you see us in today, and where do you think the VCM needs to move next in order to scale?
That's a difficult question right before I go to bed. I mean, I think I don't have anything super unique to say here compared to I think everyone else who's very knowledgeable here. I mean, we've been at this stalled liftoff point for some years. We kind of know what needs to happen. It's going to take a few years to get there. I think we're doing all the right stuff. So I'm not very worried about us not having anything to do in the next years. It's just a matter of what form it takes, whether it's in the voluntary carbon market, whether it's compliance markets, government action, whatever. This is just another form of finance to do the things that we all know we need to do. So, I don't actually know where the market's going to be in a few years. I think if I said something, it wouldn't be what I really feel. I actually have no idea. But I think in terms of the trajectory and kind of the activities we'll be involved in, I think is very clear, and I think it'll just get bigger. So that's all I would really, I think, say to that. I think.
Thank you. With that, you are allowed to go to bed. I do think it's going to get bigger as well. And I think if we've all learned one thing over the last few years, it's don't try to predict what happens in this market. Just assume it'll get bigger and keep doing the important work that we're all engaged in. So with that, I want to thank the panelists so very much for making today's discussion so insightful and impactful and actionable. We thank you so much for being with us. Thank you to all the attendees for joining us. A recording of this webinar will be available soon on the Flow Carbon YouTube channel. And we encourage you all to join us in New York for our Carbon Smart Summit on September 23rd during New York Climate Week to continue this very engaging and dynamic conversation.